Hey everyone, this is Dan at Wealthquest, and today I'm going to talk through 3 year-end tax planning tips for you. So a lot of my clients think about their taxes in the spring. We file by April 15th or their extended tax return by October 15th, then they don't think about their taxes again until next year. So what I always recommend is in the fourth quarter of the year to look at, are there any planning strategies we want to take advantage of before the end of the year? So a few of the things I wanted to talk about. One is the first rule of all tax planning. So we want to defer taxes for as long as possible. So we want to push those taxes off, keep the money in our pockets for as long as we possibly can. And there are a lot of ways that we can do this. One of the most common is to just take advantage of your employer retirement accounts. So if you've got a 401k at work or if you've got a 403b at work, we want to put as much as you can into those. You can increase your contributions if you're not going to max them out by the end of the year. Talk to your payroll department and increase those contributions for the remaining periods of the year. Another way that we can defer taxes is to put more into our health savings account or our flex spend accounts, HSAs and FSAs, which may be available through your employer as well. So again, we want to put in as much as we can up to the annual limits in those. There's no tax on the contributions, and then we can use those funds in future years for healthcare expenses, and there's no tax when we pull them out. So again, you can talk to your payroll department and increase contributions, or in a lot of cases, you can also just make contributions directly to those accounts. The last way that I'll talk about today about deferring income tax is if you're self-employed, you have some control over when you recognize income and expenses. And so there's the ability to push off fourth quarter income into next year and possibly accelerate future expenses into this year. So you can work with either of those levers or both of them to say, I want to push my income tax off to a future year by either pushing off income or recognizing more expenses this year. So that's the first year-end tax planning tip, is how can I defer taxes for another year. Second piece that's really good to do in the fourth quarter is to look at your investment accounts and to see about harvesting capital losses. So harvesting losses means we go out and look in your taxable brokerage account. If any of the positions are at a loss, you can sell that position in the current year and take that loss on your tax return. And those are really valuable because they can offset capital gains you've already recognized in the year, or you may have other capital gains inside that account that you can recognize and net those together. And in this way, we're making the portfolio more tax efficient without necessarily changing the overall portfolio allocation. Whatever we sell out of, we can buy a similar position that accomplishes a lot of the same investment goals. So we keep the portfolio intact from an investment standpoint, but we become more tax efficient. Third and final thing that you should check in before year end is looking at required minimum distributions from your IRAs. So if you're over age 70.5, or if you have inherited an IRA from someone else, the IRS requires you take a distribution every single year. And your custodian may or may not tell you what you've taken and what you need to take by year end. It really is the responsibility of the taxpayer. If you don't take the required distribution, there can be significant penalties. So this is something you really have to watch closely and work with your custodian to make sure that distribution is taken every year. Another neat thing about the IRAs is if you also want to accomplish your charitable giving goals, there's a vehicle called a qualified charitable distribution that you can use your IRA and send a distribution to charity. It accomplishes your charitable giving goals and counts towards that required distribution in a really tax efficient way. So those are just 3 of the things. There are more, but those are the 3 that I wanted to talk about today. And my recommendation is you look at those in this fourth quarter and don't wait until you start getting tax documents in the spring.